We'll talk today about the Chinese exchange rate regime. The Chinese currency is officially called the renminbi, which means the people's money in Chinese. But to make things a bit more complicated, the basic unit of the renminbi is called the yuan. For the past 10 years, the Chinese puzzle has grown as there are now two kinds of yuan coexisting. There's the offshore yuan with a CNH denomination, and the onshore yuan, which is CNY. So there's one country with three denominations: the renminbi, CNH, and CNY. The behavior patterns of the yuan have always been erratic. During the Bretton Woods years, the exchange rate was pegged to the US dollar at 2.46 yuan. In the 1980s, this exchange rate fell further. That means that when this exchange rate declined, the dollar goes down, so the yuan improved against it with a price of 150 yuan per dollar. But in the late 1990s, as part of the gradual opening of its economy, China decided to make successive depreciations of its currency. And in 1993, China decided to index it to the dollar by maintaining a peg at 8.27 yuan for a dollar. This very low indexation of the Chinese currency was made despite the opposition of the US, who saw this as a way to maintain the export pressure due to the undervaluation of the currency, giving China an unfair competitive commercial advantage. Indeed, according to most economic experts, the equilibrium value should have been at a level of around 3.5 yuan per dollar. This advantage allowed the Central Bank of China to amass a real war chest with its foreign currency reserves. However, on the 21st of July 2005, in the midst of the debate on the Chinese exchange rate policy, the People's Bank of China decided to leave the absolute index system on the dollar, and the currency is now able to move with a margin of around 0.3% around a pivotal price. With this decision to revalue its currency, China seemed to have yielded to the growing international pressure. But we still have to remember that the currency remains under the complete control of the government, which is divided on the solution to their problem. They either keep a certain control of the currency and prevent its appreciation, or they bring the currency to the center of international exchanges and promote its internationalization. So to overcome this problem, the Chinese monetary authorities decided to create an alternative currency and to decline its currency in two distinct forms. The CNY, which is the onshore renminbi, remains the Chinese currency, which is only used in mainland China and is only convertible into a Chinese current account. Its cross-border use in capital accounts is almost non-existent. The CNH, or offshore renminbi, was launched on the 19th of July 2010 by the Hong Kong Monetary Authority, and it's only available in Hong Kong, and it's the offshore RMB platform. The CNH market is separate from the CNY market because of different supply and demand markets in the two currencies. It's therefore quoted at a different exchange rate from the CNY, even if the rate changes are highly correlated. The interest of the CNH is that everyone can buy issuance done in this currency and therefore receive higher interest rates than in Western countries while having a long futures position in renminbi, which could be the purpose of the transaction. Borrowing costs are much lower on the CNH than in mainland China, which allows Chinese companies to find new lenders at better rates than in mainland China. The question of the convergence between the two currencies is obviously crucial. The interest of buying bonds expressed in CNH, which is usually called dim sum from the name of the famous Hong Kong steamed dumplings, resides only in the case where the two currencies are totally correlated. So nearly 8 years after its launch, the CNH market has grown rapidly to be of a substantial size. But while Hong Kong retains an important role in the internationalization of Chinese markets, its role as an offshore yuan center could become limited. The dim sum market has begun to attract fewer stakeholders, with a sharp decline in the yuan in 2016-2017, which has decreased its attractiveness and willingness of investors to be long. But more than that, the Chinese bond market is moving away from Hong Kong. And this is mainly because of the development of the panda bonds, once again a very apt nickname, which are CNY-denominated debt issued in mainland China. The Chinese authorities admitted that in 2017, the panda market had exceeded the dim sum market of Hong Kong. So we can use the bond market's fondness for giving nicknames to foreign debt markets and think of a great image. The pandas have eaten the dim sum. As the onshore market now offers much more variety in terms of bond types and conditions, and at the same time has much better liquidity, is the offshore bond market in CNH destined to disappear? Was it just a transition product? In fact, what has changed is the gradual opening up of the Chinese bond market to foreign investors, including the Bond Connect program, which makes it possible to buy onshore bonds via Hong Kong with less paperwork on the continent. It has boosted the appeal for panda debt issuers, with many sovereigns planning quickly to tap into the market. So the recent rise of the Chinese currency trading is now at its highest level for 25 years. But is this going to change the game again?